Hello and welcome back to another episode on money management in Forex trading. In this episode, we are going to talk about position sizing and how to determine the size of your trades. Position sizing is a critical aspect of successful trading, as it determines how much money you risk on each trade. Position sizing is the process of determining the number of units or contracts to trade based on your account size, risk tolerance, and the market conditions. The first step in position sizing is to determine your risk tolerance. This is the maximum amount of money you're willing to lose on any given trade. A good rule of thumb is to risk no more than 2% of your account balance on any trade. Although some traders may be more or less conservative depending on their risk appetite. Once you have determined your risk tolerance, you can calculate the position size based on the distance from your entry price to your stop loss level. For example, if you're trading a currency pair and your stop loss is 50 pips away from your entry price, you can calculate the position size based on the amount of money you're willing to risk. To calculate the position size, you can use a position size calculator, which is available online or through your trading platform. Simply input your account balance, risk tolerance, and stop loss level, and the calculator will tell you the number of units and contracts to trade. It's important to remember that position sizing is not a one-size-fits-all approach. The size of your trades will vary depending on the market conditions, volatility, and other factors. It's important to adjust your position sizing accordingly to ensure that you're managing your risk effectively. In conclusion, position sizing is a critical aspect of successful trading. By determining your risk tolerance, calculating the position size based on your stop loss level, and adjusting your position sizing based on market conditions, you can effectively manage your risk and improve your chances of success in the market. There are several position sizing methods that Forex traders can use to determine the size of their trades. Here are some of the most common position sizing methods in Forex trading. First, fixed position sizing. This method involves trading a fixed amount of lots or units on each trade, regardless of the size of the trading account or the market conditions. For example, a trader may choose to trade one standard lot on every trade. Next is the percentage risk position sizing. This method involves determining the position size based on the percentage of the account balance that the trader is willing to risk on each trade. For example, if a trader has a $10,000 account balance and is willing to risk 1% on each trade, the position size would be $100 per trade. Next method is fixed fractional position sizing. This is the method to determine the size of a trader's position based on a fixed percentage of their trading account balance. With fixed fractional position sizing, traders risk a percentage of their account balance on each trade, which means that the position size will increase or decrease depending on the account balance. For example, if a trader has a $10,000 account balance and decides to risk 2% of their account balance on each trade, the maximum amount they are willing to risk on any given trade is $200. If the trade has a stop loss of 50 pips and each pip represents $1, the trader would trade 4 lots, which is $200 divided by 50 pips multiplied by $1 per pip. If the trader's account balance grows to $12,000, the maximum amount they are willing to risk on each trade would increase to $240, which is 2% of $12,000. This would result in a larger position size for the same stop loss distance, which means that the trader would be able to potentially earn more on each trade. Fixed fractional position sizing is a popular position sizing method because it helps traders manage their risk more efficiently. By risking a fixed percentage of their account balance on each trade, traders can ensure that they are not overexposing themselves to the market and are limiting their potential losses. Additionally, as their account balance grows, traders can then increase their position size accordingly, which can help to maximize their trading profits over time. It's important to note that different position sizing methods may be more suitable for different trading strategies and styles. Traders should choose a method that aligns with their risk tolerance, trading goals, and overall trading plans. And this is all for today. See you next time.